everyone here is ready to learn, and have a very good understanding, of how investment works. Just like they said, there's a bridge, there's a gap, right, in between how investment works and how some entrepreneurs don't really know how it works, right? So everyone here is here to learn, and we're very grateful that you gave us, the honor to have you here today. I'm so humbled. Like, the profile alone is very amazing, from FMDQ, to Morgan, to Norwich Capital. We're really, really humbled to have you here. So, first question, right? Here we would like to ask, sir, from the Morgan Capital, right? To give us a brief about your company and how you guys have been able to help with investments in Nigeria so far. Thank you.
Thank you, moderator, for inviting us. Morgan Capital. Well, Morgan Capital is an investment banking group. We specialize in investment banking, financial advisory, asset management, stockbroking, right? Basically, we assist clients with capital raises. That's the investment banking arm. Capital raises could be debt capital, could be equity capital, it could be mezzanine, right? So we assist clients or entrepreneurs, to raise capital. So it could be private capital, it could be public capital. That is, we take them to the public market, take them to the exchange to list. We do this by using instrument like we can go through an IPO route. That is for a company coming to the capital market for the first time. We can also do a public offer for mature companies. Another instrument like right issues, right offers, and the likes. That's on the equity side, right? Then on the debt side, so we assist corporate. That's through corporate bonds. Companies also need debt funding, so we assist in packaging documentation that the bond circular, bond prospectus that is being shared among investors for them to invest, basically. So we assist in preparing investors, entrepreneurs, small size, mid-size, and large corporates with their capital needs. Right, that's on the investment banking arm. On the stockbroking arm, that is, we are majorly retail, so we have a large pool of investors that trade on our platform. We have a stockbroking platform called iTrade, where you can buy, you can sell equities, right? So without the intervention of anybody, once you open an account, you can just log on to the website on your mobile phone or to the web portal. You can get to buy all the equities that are listed on the exchange, right? So that's on the stockbroking. Then we also assist with asset management and portfolio management also. That's like a brief of what we do in Morgan Capital.
All right, thank you so much, sir. We really appreciate that very nice introduction. And I hope everyone here is listening to what they really have to offer, right? Because we have lots of questions for them, right? So right next, we'd like to go to Ms. Henrietta, right? To basically introduce us, to what we really do. Thank you, ma.
Thank you very much. And it's great to be here. A lot of young people, trying to make impact in Nigeria. And I'm really, really proud of you all. Can you please put your hands together for yourselves? Before I talk about my company, I just want you to have a bit of context. There are over 42 million micro, small, and medium enterprises in Nigeria, all right? And 80% of employment in this country is driven by micro, small, and medium enterprises. And indeed, you account for 50% of Nigeria's GDP. Isn't that an amazing statistics? So put your hands together for yourselves. You are important. You are important. I just wanted to put that out there. My name is Mrs. Hetty Ugboh. I'm an ex-banker. Like they said earlier, I worked with Citibank for 30 years. And when I left Citibank, I needed to make an impact, again, giving back and supporting the young as well. So I set up a company called Norwich Limited. And why was it set up? It's really to offer financial and business coaching and mentorship. All right. So I'm the founder and CEO of that company. Now, my specialty is in financial literacy. I did corporate and investment banking all my life in banking. And I know that a lot of young people, a lot of women get scared over numbers. When you talk about balance sheet, profit and loss account, cash flows, you find people cringing, they're afraid of it. But it's not rocket science. So my company tries to demystify the fear of numbers, for people, the youths, women, and entrepreneurs. I'm also an angel investor. I'm a member of the Rising Tide Africa, one of the pioneer women angel investors. We're about 90 women in that group, and we pull together to invest in businesses. I'm also a leadership coach. I'm a certified trainer, teacher with the John Maxwell leadership team. So in a nutshell, that's what I do. Thank you.
Wow, thank you so much for that very amazing introduction about what your company does, and also, based on your profile, we really do appreciate you, for sharing that with us. Right. Okay. So right next, we would like Mrs. Jumoke Olaniyan, right, from FMDQ as well, to introduce herself. Thank you.
I echo everything Ms. Henrietta said. It's very inspiring to see so many young people championing the future of Nigeria. My name is Jumoke Olaniyan. I work for FMDQ Securities Exchange Limited. It's one of the subsidiaries of the FMDQ Group PLC. FMDQ Group is what we call a financial market infrastructure group. I'll just break it down a little bit. In the financial market, you need various types of institutions to facilitate the transactions that go on in the financial markets. And FMDQ is one of the very few companies, well, one of only two in Nigeria that has 3 subsidiaries that provide the services for the full value chain of transactions you have in the financial market. So we are a group of companies with 6 subsidiaries. 5, sorry, with the group. FMDQ Exchange, Securities Exchange Limited. It's an exchange that facilitates the trading of financial market transactions. FMDQ Clear Limited, which is a central counterparty. Their services are towards minimizing risk in financial market transactions. We have FMDQ Depository Limited, which is a depository. The easiest way I like to describe it is bank is to cash as depositories are to securities. So you keep your cash in the bank, you keep your securities in the depository. And then we have FMDQ Private Markets Limited, which is a platform used to facilitate raising capital for private companies, where a lot of yourselves, SMEs, will fall into. And finally, we have IQX Consult Limited, which is our technology development and subsidiary. So all of these companies together, we provide services, we innovate, we engage, we educate in the Nigerian financial market towards facilitating how we can support economic development in Nigeria. We believe strongly that development in Nigeria can be financed from the capital market. You and I and a whole lot of people have funds in this market where we are looking for how to champion it into viable projects, viable initiatives that will ultimately, continue to benefit and generate build the economy as a whole. And in FMDQ, that is our main mantra, which is how do we bring the capital market, bring the financial market closer to the economic and socio-economic issues, challenges, and deficits in the Nigerian economy. So that's what we do in FMDQ. Thank you.
Good morning, everyone. My name is O.T. Lenterman. I am an investment manager with Alethea Capital. Alethea Capital is an impact investor where we deploy primarily equity-type funding into small and medium enterprises. We, at the moment, invest out of 2 funds. We have an impact fund that invests into earlier stage businesses, and then we have another fund, yes, where we invest larger ticket sizes, that's larger amounts into bigger companies. We don't do debt. We typically do primarily equity or quasi-equity, which is what would you call preference shares, where we are able to convert into equity if for whatever reason the business is unable to pay back the funds invested. We do not focus on the primary sector, so we are sector agnostic. What that means essentially is that we would look at any sector as long as we deem the business to be making impact in whatever realm or sphere in which that business operates.
All right, thank you so much for that very amazing introduction. We really appreciate. Right, so let's get into the discussion now. I suppose this is what we're all waiting for before the investment session starts. Right, so first question I would like to ask, why Alethea Capital only prefers equity investments, why don't you do debt? And again, what kind of businesses do you invest in, so everyone here has a very good understanding of your company? Is it agriculture, is it finance, is it marketing? Just give us a very good understanding of what you do. Thank you.
So we don't do debt because there are other companies that provide debt. So we focus on providing more what we call patient capital. And we, beyond even investment, we're looking to help these businesses create value, and because that's where we get our upside, where we typically invest for a 5-year horizon, and after that 5 years, we're looking to exit. So the amount of value and the growth in which that business has been able to record over those years plays a very important role in our returns as a company. As far as sectors we focus on, we use a broad umbrella to define that, called any business that's providing an essential good or service. So that could be in finance, in agriculture, in technology, and whatnot. But ultimately, your business has to be providing an essential service, meaning you are looking to your addressable market size must be quite significant.
Right, thank you so much for that. I suppose we still have more questions, but right now we'd like to, pass the mic around for other speakers as well. Right, so I think we should go to FMDQ, right, Mrs. Jumoke Olaniyan. Thank you, teacher. Right, so I would like you to educate us a bit about how the financial market is in Nigeria, right, and how sustainable or profitable it is, right? So, for businesses here, they can get to have a very in-depth understanding of how it works. Because trust me, I'm just an entrepreneur, right? I'm a farmer, right? So when you're talking about this financial markets, to someone who does not really understand how it works or how it is, please, we'd like you to explain so we can have a more better understanding, right? So while we're living here, we understand how the financial market is and how it works in Nigeria. Thank you.
Oh, I'm having deja vu. In my past life, I used to be a teacher. So
very nice, very
nice.
How
do you break down financial market in 2 minutes? Okay. There's money in the system. You and I have money we earn every day, be it from salaries, be it from business, and the likes. And the primary or principle, one of the cardinal or principal things you should always do with money is try to grow it. As in, let your money, when they say let your money work for you, what do I put it into such that it generates more money for me as I sleep, as they say. So the financial market, which is a subsector of a financial system is much bigger. Financial system will include your bank, your insurance, your pension, anything to do with finances will be the financial system as a whole. But your financial sector, financial market sector, is one subsector of the financial system. Now, the financial market is the sector that focuses on the development of, let me use the word, processes and tools by how you can grow your money, how you can keep your money and grow your money. So you will hear terms like securities and investments. These are the kinds of products you invest your money in, and they will earn you a return eventually. There are various types of products in the financial markets. You heard my co-panel speak about equities. We all know about the Nigerian exchange group where equities trade daily. There's also debt. Debt is the word as you know it. You borrowed someone some money, they're going to pay you back with interest. But debt can be structured in different forms. So under debt, securities, you would hear bonds, you would hear commercial papers, you hear treasury bills, you hear promissory notes. Fixed deposit is under debt as well, and there are other types of products. And then there's a whole bunch of products we call alternative assets. It can range from a combination of debt and equity, or just a structure that we cannot categorically put under debt or equity. Now, the idea is that the people who need funds are looking for the people who have excess to give them their money for a period of time, whether it's a debt security or an equity security or an alternative asset, and they will pay something for having used your funds or your excess money for a period of time. So the market where this exchange happens, where the party who needs the extra money and the party who has the extra money to invest meet themselves, exchange the funds, document the basis and the conditions under which money is exchanging hand, is the financial market. So let me use the FMDQ companies, for example, to explain to you how the transaction would happen. A very popular one is treasury bill. Let me use treasury bills as an example. Treasury bills are short-term in nature. They don't go longer than 1 year. Treasury bills are the federal government of Nigeria's instrument for borrowing short-term. If it's not the federal government borrowing short-term, you will hear commercial paper. That's the short-term version for a company that is not federal government of Nigeria. So treasury bill is where the federal government will come to the market and they want to borrow funds. It's a debt instrument. You and I and anyone who has excess cash to invest will go to that auction. It's announced twice a month. And we will bid for that treasury bill. We will say what rate we're comfortable to borrow our money to the federal government of Nigeria for. And they will tell us what tenor it is. It could be 1 year, which is 364 days. It could be 182 days. It could be 90 days. I think that's about the tenors that they typically do. And when that is done, the transaction needs to settle, meaning money needs to leave your account and goes to the federal government's account, right? And you need to receive something back that says, I borrowed the federal government some money for a period of time. That is the treasury bill set security. So your bank account is debited for the cash, and your depository account is credited with the security to show that you actually gave the federal government of Nigeria some money. Over the tenor, you'll be earning interest on the security. In this case, it's a treasury bill security, so it's a debt instrument. And on the final day, the reverse will happen. The cash is paid back to you, plus the interest for the period of time you've lent out the money, and the security is extinguished because it no longer exists. So that's just one very simple and quick example of a financial market transaction where you earn a return on the security. So for example, I think treasury bills are at around 10 to 12%, depending on the tenor you're investing in. The bonds will happen the same way. So you can have Federal Government of Nigeria bonds, which is the federal government borrowing money from the public, you and I and anybody else. But in this case, it's for a long tenor. It is for anything above 1 year. Today, we have federal government bonds up to 30 years. Now, would you want to borrow your money for 30 years and go to bed and not receive anything for 30 years? How many people are happy with that? Let me see your hands.
To do that?
Is that all right? Absolutely not, right? You want to earn something within the period. So bonds have something called coupons. Coupon is simply an interest payment. And it's simply saying that because this is a long-term security, 30 years, as you can imagine, periodically, I will pay you a portion of the interest for the monies I'm holding. You've borrowed me. So typically, the most common is coupon is paid half yearly, so 6 months. So for 30 years, every 6 months, you receive an interest. And then on your final 30th day or year, you receive the money you invested plus the last interest or coupon. Right? Makes sense, right? Instead of sitting down for 30 years without receiving any interest. But there are some bonds that are structured that way, where no money is received until the last day. But, I mean, you can imagine that must be for very sophisticated investors. Those are two very quick types of debt instruments that are very common. Just as the federal government can issue a bond, a corporate institution, Dangote, MTN, Cadbury, Lafarge, can issue a bond to raise money from you and I for expansion of their business, for development of their business. In the exact same manner, when you give them your funds, you're going to receive interest, coupons, for the period or the length of the bonds. Corporate bonds can go as any tenor right now. If I remember, I think the longest I've seen is 15 years of a corporate bond. I may be wrong, but I think so. So that's bonds. Equity, on the other hand, means that you've given your money and you've bought shareholding in the company, meaning you own a portion of the company you gave your money to. When you invest equity, you are not receiving interest because you bought something. All right? You didn't lend the money. You bought it. So you own a portion of the business. In that case, when the business makes profits, they should pay you some of the profits. That is what is called dividends. And that is what is paid periodically. Now, it's not cast in stone, of course, that the business will always make money. So there's risk in it, whether they make money or not, whether you receive a dividend or not, or even how much dividend you will receive. Now, a key difference between equity and debt is, for debt, we also call it fixed income. Why? You know exactly what your interest rate is. It's not changing. You know exactly what your return or the interest they're going to pay you on the debt instrument is. So it's fixed. For equity, you can't know that because you don't know whether the company is going to make X amount of profit or a loss, because that can happen. So equity, we say, has unlimited upside and unlimited downside because you don't know which way the company is going to go. But a key principle in financial market, they say, is the more the risk, the more the reward. So while you can make unlimited upside on equity, on fixed income, your money is, you know the exact amount of money you're going to make. So generally, we would say diversify your portfolio. Have a bit of your funds in fixed income, is certain, I'll use the word secure, because you know exactly what you're going to earn. But also be flexible to want to go into a little bit of more risky assets so that you can also earn an upside as well. I hope I was able to do justice
Of
to
course.
that. Thank you.
You did amazing justice to that, and I think now I have a very good understanding of how the financial market works, and I really do appreciate you for that. So I think now we'd like to go to Mrs. Henrietta, right? And we would like to know the kind of companies Norwich Capital invests in, and what amounts you invest in companies. Like, okay, for what industries do you invest in? You know, what tenures are in between, like the investment, so at least everyone here has a very good understanding about your company and how you invest.
Thank you very much. Okay, I'm wearing two hats here today. My company, as well as Rising Tide Africa. Okay, so my company is more into education. So teaching, mentorship, and coaching. Okay, and we are sector agnostic. As long as you have a need and you need help, we'll step in to support you. Nothing esoteric, simple, and straightforward. But I think the reason why you need me here today is the angel investing hat that I'm wearing, right?
That's very correct.
So I'm a member of Rising Tide Africa, and I sit on the education pillar. Now, Rising Tide is a group of female angel investors. We are about 90 in all, and we pool our resources, we pool our network, our passion, and our power together to support startups. All right, and as you can imagine, startups can be very risky. Okay, and Jumoke talked about various asset classes, and angel investing is an alternative asset class, and I would like you to look at it as such, especially for investors. It starts with an idea, with you trying to profess solution to a problem. Okay? So once you have the solution to a problem, you need funding. And typically startups start with their own funds. You start with your personal capital, or you get capital from family and friends. At that point, no bank will touch you, right? Because
so
you
if
do not
everyone is
have...
understanding now for the pitch, right? At least they've been able to like have their own investment in their business from the onset, right? Before they can approach the Rising Tide, right? Okay, that's very nice.
So you have your own, you would have started, okay? So typically what Rising Tide does is that they invest in pre-seed and seed, at least before Series A. So there must be a solution you're providing to an idea, and you have started already. So basically, we support, we are sector agnostic, but we are interested in the healthcare, essential goods and services, technology, financial inclusion, and education. Now, you must have a defined size of addressable and obtainable market. You must have a target market clearly defined. Now, in terms of the investment stage, we primarily focus on seed to pre-Series A investment. And we look at startups. Startups that we post revenue and pre-revenue, although opportunities outside of this criteria will be considered. Now, in terms of the company age, our preference would be to give companies that have a developed product and market. So between 1 or 3 years minimum, you should have started this business. We also tend to look at the presence and caliber of your advisors and or board of directors. That helps us a lot. It tells us that you have the right people behind you or supporting you. And then another thing we tend to look at is we look at you, the entrepreneur. How passionate are you over this business. All right? You see, angel investing is about the individual. You may have the right business model. You may have the right words. You may be eloquent. But if you do not have passion, if you're not enthusiastic over that business, then it becomes a problem. If there's an integrity issue or credibility issue as the entrepreneur, it becomes a problem. But I'm quick to say that angel investing is high risk in nature. And as you expect, higher risk, higher returns, right? All right. So if you're an investor, it's something you have to think about. And when we teach it in financial literacy, it's one of the things we say about diversifying your portfolio. Jumoke talked about fixed income. She also talked about equities. So angel investing is also an asset class. So it's either you're investing in real estate, you're setting up your own business where the angel investors can come in and help you. Now, in terms of ticket size, we typically we can do as low as $20,000, and we can go as high as over $100,000, depending on the sector and the interest. And
sorry to cut you short, Ma. You said you can go as low as $20,000 and as high as $100,000. Do you go below that, or do you, like, for instance, if there's someone here where their business needs, let's say, $10,000, and how do you match up to know, oh, this company is worth this amount, this company can accept this amount? You know, what are the metrics that your company use to validate that?
all right, thank you very much. Okay, like, recall I said that we're a group of women, so it's not just one person. So we have what we call the pitch day. We listen to pitches, right? Once a month, we aggregate all the requests, and then we spend 1 or 2 hours listening to pitches. And then after we have listened to the pitch, we look at it, like I mentioned, it should be, one, we are sector agnostic, so it doesn't matter which sector, as long as you're not doing anything illegal. So it's not firearms, it's not prostitution or anything illegal. All right? Our focus is on Nigeria and Africa, as long as you're operating there. And then your product is great. It's scalable. That is, you can move it from one level to the other. So as a group, we discuss it. Okay? And then if a lot of women are keen on it, then we know that we need to do due diligence on you. I mean, it's not enough that you've come to pitch to us, right? We have to do our due diligence. And that's what we do. We ask for a lot of information. Information about the market, competitive landscape. We ask you about management. We ask you what you're going to do with the money. It's very important, okay? And then we look at entry, barrier to entry. If your business is one that every Tom, Dick, and Harry can go in, it becomes a problem. So what is your unique selling point? So we look at all that, and then we put a deal team together to look at your business. And then by the time you have passed a due diligence, we now ask all the women to start making their commitment. So it's not one person putting out all the money. This one puts X amount, that one puts X amount, and then we aggregate it. So if it's a good opportunity, you have higher appetite for that opportunity. But if it's not such a good opportunity, you have lower appetite for it. So it's based on the appetite that each person has for that company, for that sector, that allows us to put money into. And our portfolio in Rising Tide Africa is very diverse, cutting across all the sectors. So that's it.
All right, thank you so much for that. I really do appreciate. And thank you so much for sharing with us that, Rising Tide has a community of 90 investors, so I suppose everyone here, if your business is very interesting, you have a community of 90 investors who would be willing to hear you out if you pass this first stage today, right? Okay, so now let's go to Morgan Capital, sir. I've seen a whole lot of great things that your company does, right? So now my question is, okay, how do you value companies, right? To say, oh, an equity would work for your company or debt would work for your company, and how do you validate? Okay, like, oh, for instance, if a company is doing a revenue of 50 million naira annually, or let's say 30 million naira annually, how do you value that? Oh, that's the worth of this company, or is it the entrepreneur or the startup that will have to tell you, for instance, like they say, this thing is relative, right? It's not really absolute. Like, so I just want to give examples so you have a very in-depth understanding of what I'm trying to say, right? So let's say a company here now is doing a revenue of, let's say, 50 million. If you're to invest in that company, let's say for equity, like what equity stake would your company be interested in, right? And again, how is your strategy? How does it go, right? Yeah. And for instance, okay, if I tell you, my company, we're doing 50 million annually, and we would like to give, I'm just assuming, right? So you can help me, you can clarify with that. We want to give 10% or 20% equity of our business, and okay, and I'm telling you, okay, sorry, I'm saying 10%, and I'm also telling you that these are projections. In 10 years, in 5 years, we want to do from 30 million, we want to be able to do 300 million or 400 million, and we show you clear values of how that is possible. And what do you use to measure? And if I'm telling you based on my markets, would it really work?
Thank you for that question. Yeah, so on valuation, basically, most times when we are approached by entrepreneurs with a business, so most of the time they come with a business plan. Business plan, and in that business plan, we have a lot of information. The information cut across industry information, market information, as regards the level of macros and all that. We also have information around their financial projections. Okay, so when we are being approached by entrepreneurs with their business plan, so they come with business plan, they come with financial models, right? So our job basically is preparing them for funding, basically. And in preparation, you want to be sure that the financial model that they are presented you with, it's accurate. Of course, it won't be 100%, right? But our job is to look at the assumption underlying the model, right? Because the model will show revenue projection, their OPEX projection, their CAPEX projection, their CAPEX needs, and that is the funding they need and what they want to use it for, right? And so we look at the projection, we look at the underlying assumptions, inflation numbers, the GDP figure that they have used to go the numbers, or maybe the sector, the growth rate in the sector, right? So there will be information around the sector too. It could be the banking sector, it could be the tech sector, it could be agro sector, right? So we look at all those projections, and based on that, we can come up with a valuation, right? In valuing them, so we look at several metrics. Like you mentioned, they have revenue numbers.
Yeah, the revenue, their
yeah. So from the revenue numbers, you can come up with what they call, you can use what they call a DCF, a discounted cash flow.
Discounted cash
flow methodology to value the business. So you start from the top, right, which is the revenue. Then you adjust for some expenses. So you come up with your EBITDA, right? Then from the EBITDA, you have other assumptions around the discount rate, the weighted average cost of capital, and all of that. Based on that, you discount the future cash flows of the company, and that will give you what they call an enterprise value. You understand? That's the value of the company, right? So based on that value, that valuation is what we take to the market. Depending on the investors we are trying to pitch to, right? We can go with either the enterprise value, or we come up with an equity value per share. You understand? Of course, we look at the number of shares in issue, right? We can use that to divide the equity value. So from the enterprise value, you adjust for debt. Then when you adjust for debt, you get the equity value, right? So that equity value, you can get equity value per share, right? So if you are, let's say, doing an IPO, that is, the company is just coming to the market for the first time, right? You need to have a value per share that you feel, you think this company is worth. So the entrepreneur has approached you. Your job is to prepare, do the valuation, prepare the prospectus, that's the marketing document you take to investors for them to put down their money. So you can say, based on your valuation, using DCF, using other valuation metrics, it could be asset-based. You can use if they have assets in place, you can do net asset value approach. Do you understand? Then you can also do market multiple. If the company has comparables in the market, like for example, if a bank is trying to come to like a new bank trying to come to the market, look at existing banks, right? Look at the multiples, P, price to book, price to earnings. That gives the valuation of the company.
Okay, so basically,
Okay.
you do the what's it called? You do the marketing document, then you go to the market, right, and ask for investors to invest. So investors cut across your retail investor, your institutional investor. Institutional investor could be PFAs, could be insurance companies, could be funds, asset managers, right?
Legal capital, right? What do you really look out for when you want to invest in a company, in a project, right? And what are the metrics used to determine debt you want to take and what the stake would be like in the company?
Okay, we don't take debt, only equity. What we look at is quite similar to what Rising Tide looks at as well. We're looking at how long have you been in business, what's your revenue as of the last financial year end. We're looking at the market in which you're looking to, or you provide your good or service to, what's the size of that market. We're looking at the ability of your business to scale, meaning, say, for example, you're doing 20 to 30 million naira. We're looking at what is the potential of that business to be able to grow from a 30 million naira business to a 1 billion naira business. Is that feasible? If we deem that as feasible, we're looking at how can that company get to that point. Has that company clearly defined its go-to-market strategy? Does the company have the right management? If the company doesn't have the right management, does the company at least have the right founder who has a vision, but there are gaps in management that need to be filled? We're looking at corporate governance. It's very difficult for businesses, particularly when you're starting, to grow the business, sell your goods and product, but also still institute a board or get an auditor to make sure you have audited financials, your financial reporting, making sure that is on point, visibly growing the business. That can be quite difficult for businesses at the beginning. But we are definitely looking at that because that's your path to get into a point where your governance structures are proper. It will be one of the things we're looking at before we look to make an investment in that company. So there's a whole lot that goes into making that final decision. Sometimes we tranche the money. What that means is if say for example we want to invest $500,000 into a business.
Is that the amount?
See the size of the investment, for example, $500,000. We then say, look, we will give you $200,000 now if you meet certain KPIs, as key performance metrics. Yes, it will say within a year, and that will unlock the 300,000. But we also will work with you to help you achieve those metrics. If say, for example, we need to get an advisor to come in to help you clarify your distribution strategy. That will help to increase your market penetration. That in turn, obviously, your revenues, your EBITDA numbers, your net profit should go up in theory. And if you meet those metrics, then that will unlock the $300,000 in this 500,000 ticket size investment example that I just provided. So these are the things we're looking at. But to the speaker's point, where she said the most important thing is the founder or founders. You're looking, and that there's no empirical, there's no quantitative way to actually measure that. That is something you feel from your interactions with the founder. You're looking to gauge the commitment of that founder or founders. You're looking at their drive, you're looking at their tenacity. Particularly when you operate in a market like Nigeria, you're looking at that. If we deem that founder has that, with a good business model, but just needs capital and some other items to really scale that business, then then we will potentially be looking to invest in that business.
All right, that's a great one.
I wanted to add to that.
Thank you very much. Thank you.
So in FMDQ, we also have an accelerator program. And one thing we've learned in the accelerator program is to try and hit the nail on the head always and make it simplify. So we have something called the SME Octagon, which is helping to summarize all of what my brilliant panelists have helped say. If you notice something they've said is your business must have started, your business must have been running already, which means you should have started, you probably started with funding from friends and family, unstructured private credits, and the likes, right? But that does not mean you shouldn't put the building blocks in place so that once you're ready to scale, once you're ready to grow, you are in a perfect state, about as perfect as can ever be, but in the right state to be able to attract their type of funding, which is your seed and pre-seed. And I'll just read out the octagon for you. Octagon, if you remember your mathematics, is what? 8, right? So just grab your pens very quickly. Governance, very important. Who are you accountable to? I mean, as he said in the early stage, you may not have the perfect governance structure like a established company, but who keeps you in check in the policies and the procedures of your business? As simple as that needs to be. Separation. You must separate personal finance from business finance from day one. What you do not practice, what do they say? Practice makes better. Well, they say not perfect. They say better. Yeah? So, what you start to practice from day one becomes second to nature and easy to keep. So, once your books are coming to place for their type of financing, you already have the practice in place to separate your personal finance from your business finance. Always. And guess what? It gives you a clear picture of your business every time because you're not putting your personal finance, mixing your personal finance with your personal business. Structure. Even if it is a two-man business, there's a structure. Who does what? Does everybody run around doing everything? Or is there structure of who does what? And therefore, you can hold certain people or specific people accountable for specific processes in your business. So it gives people a sense of responsibility in your business. It also gives your business structure. Discipline. In fact, maybe I should have said this one the last. I think this is the one that's the foundation of everything else. So let's jump discipline. Just hang discipline and let's come back to it. Transparency. As you've heard from both of them, they're going to ask you for a lot of information because it is needed. It is needed to get insight into your business. It's needed to get insight into how your business has grown. It's needed to get insight into what is the next phase of the growth of your business. And therefore, transparency of the documentation of your business is most important. And what does that lead back to? Keep records of everything. Make sure you keep records of everything in an organized manner that you can easily bring it out when it is needed. You never know when it is going to be needed. Receipts, no matter how in any form, I use this word mentor because as a new business, you're going to have a lot of things that are not in the standard form of a structured business. It doesn't mean it's not relevant, and it doesn't mean it's not important. It is very important. So keep records of everything, label them well, organize them well, and that gives you a good foundation for transparency of your business. Management. At the start, it might just be you that is management. But again, it ties to governance. Are you open to advice from professional parties who can guide you accordingly on how your business needs to be managed? At the end stage also, it might look like cost. And yes, cost must be balanced with the sustainability of the business. But never look at it as a one-time cost. Never look at it as a sunk cost. It's a cost you incur today for the benefit in the future, especially when you now need to scale your business because you're going to need that capital. Friends and family can't fund everything. So you're going to need your angel investors, you're going to need your private equity, venture capital. If it is private market, which is the financial market side of it, these are critical. It can't be done away with. Without them, you're hardly ever going to be able to get that source of finance to help scale your business. All right, sorry. Drivers, two more, and I'll get back to you. Drivers, meaning you must know your business. You must know your business. And the both of them spoke about it. You must it's not just to know I'm selling this. What is the impact of your supply chain to your business? And what is the impact of your demand to your business? Because both impact your business. The disruption in supply means your cost of business goes up, and you don't have opticals for your business, means revenue is not coming in. So it's not enough to just know I do this and that's the end of it. You have to know what is going on in both your supply chain, backward integration, and your demand chain, which is forward to you. So read, thank God for the internet these days. There's so much news out there telling you what is going on. It will tell you why there's no meat or why there's no chicken supply. The container Apapa port has been shut down. They are not clearing container for frozen turkey. It's as simple as that, honestly speaking. Those things impact your business. So you need to know the drivers of your business. And you need to know how to speak to your business in clear terms. What are your services? What is your product? What is your unique selling point? And then I go back to that point we on discipline. You will not be successful in these 7 points if you do not have discipline. And discipline can be taught. It takes little steps done every day to achieve discipline. Thank you.